Hello, and before we deep dive into SBR, I just want to make sure that everybody is happy with the basics of a group statement of financial position and a group profit and loss account. And there are one or two little nuances that I want to make sure that you're comfortable with. So the colloquial name of a statement of financial position is the balance sheet, because the balance sheet should balance. Yeah, it's got two halves, two sides to it, which should aggregate to the same number. Now, the balance sheet is a very static document. It's a photograph. It's showing a list of the assets and liabilities at a particular moment in time. In other words, after you've just prepared the P&L and it's at the year end, you prepare a statement of the company's financial position. So it describes exactly what it is. It's a statement listing out the assets and liabilities. And that's what it looks like. That's what a group statement of financial position, well, the top half looks like. So these are the categories. These are the names that we tend to use. And you've got your non-current and your current, and your distinction is around 12 months. So you expect the intangibles, the PPE, the investment in the associates to be there for more than 12 months. Because it's a group, we are expecting intangible assets, i.e. goodwill. Because it's a group, it's perfectly normal to have an associate that is equity accounting. We are going to look separately at goodwill. A lot of detail. We're going to look separately at associates and equity accounting. The other name for inventory is stock. The other name for receivables is trade payables. These assets all shown as positive numbers. Technically, they are all debit balances. But that's only one half of the balance sheet. The other half of the balance sheet is your equity, is your ownership interest. That's part of the bottom half of the balance sheet. And there are four parts to equity. Share capital. This is the capital that was introduced by the owners in the first place when the company issued shares, and this is recorded at the nominal value. And then there's other components of equity. Now that's a much more dustbin type of account. There's all sorts of things in other components of equity. For now, let me just say revaluation reserve, revaluation gains, but it could include share premium, it could include group exchange differences, and the more we study SBR, it could include share-based payments and all sorts of weird and wonderful differences. Retained earnings are the earnings that have been retained. Retained earnings are your accumulated profits. The profits that have gone through the P&L and not been distributed by way of dividend. And then we have our non-controlling interest. And our non-controlling interest arises because we're in control of a sub, but we may only own 80% of that sub. But being in control of the sub, the control of the subsidiary, means that we fully cross-cast because we're fully accountable for the plant, the inventory, all of the assets and liabilities. So 100% of the subsidiary's assets are included, but because we only own 80% of them, we have to admit, we have to acknowledge, we have to report there is an ownership interest, and that's the NCI, that doesn't belong to the parent. So we have there the NCI. Now, the balance sheet doesn't balance yet until you take into account your liabilities, your debts, your obligations to third parties. And these can either be regarded as non-current, deferred tax loans, or current, trade payables, bank overdrafts, that kind of thing. But the balance sheet should balance because your total assets, should be the same number as your equity and liabilities. So if that number is 500, okay, what we could say is if you buy a property, an asset for 500, if you or me buy a property for 500 and we borrow 400, the mortgage is 400, the debt is 400, 100 is said to be the equity, our ownership interest in the asset. The net assets. The 500 minus the 400, the asset minus the debt gives us the equity. And some of you may know that as the accounting equation, but you're not really going to be tested on the accounting equation at this level, but I throw it in as an aside. Every number on that balance sheet is a positive number. The top half are all debits, but your equity and your liabilities are all credit balances. This is what a statement of financial position looks like. You do not have to rote learn it as such, because in the exam, in question 1, you're given a pre-populated spreadsheet and then you are amending it. So it's not something you prepare from scratch. You will be given this information. This is a gentle recap. So your statement of financial position is a static, is a photograph, is at a point in time. On the other hand, when we look at the profit and loss account, it's like a video. It's telling a story for 12 months. The profit and loss account is a performance statement. It's looking to measure the profit over a period of time where you compare your income and your expenses. And if your income is bigger than your expenses, as we assume, we call that a profit. And this is what a profit and loss account looks like. Revenue is the first number. And sometimes people call that sales. Sometimes people call that turnover. But technically, it's revenue. Take away the cost of sales. So Sainsbury's, a supermarket, will sell the goods, but it will buy them in. The difference is your gross profit. Then you've got your wages and your operating expenses, sometimes called admin, sometimes called distribution. You take those away and you get your operating profit. If you've borrowed money, that'll cost you. And then, of course, you also have to deduct your taxes before you get to the profit for the year. Okay? So this is what the profit and loss account looks like. But I have to tell you, you've got positive and negative numbers in that P&L. The positive numbers are credits. So revenue and profits are credits. Should you want to know that, you don't have to know double entry, but the negative numbers are debits. So just something to be aware of, perhaps. You're not going to be tested on loads of debits and credits within this exam, but I'm just making sure you understand the principles. And one of the big things that I want you to be aware of is that not all gains and losses are recognized in the P&L. So that is an incomplete picture of the financial performance of the business. Because in addition to the operating, in addition to the trading, in addition to the realized profits that have gone through the P&L, you can have gains and losses that go directly to equity because they're rubbish, because they're low quality, because they're one-off, because the accounting standard requires you to do so. Now, I've put some numbers here. They're arbitrary numbers. I think the best example, the simplest example at this stage that I can say that would be a gain that's not in the P&L, but you would include in other comprehensive income, is a revaluation gain on PPE. Now, at this stage of the game, don't be worried about this classified, not reclassified malarkey. I will explain that properly when we do the framework lecture, which is coming up. I just want you to be aware that not all the gains and losses are in the P&L. Some have gone to equity, and we include them in other comprehensive income so we can give a complete picture. I wish that was it. But there is a further problem, because just like in the group statement of financial position, there's a non-controlling interest. In the group statement of financial position, when we had a sub, we aggregated all of the assets and all of the liabilities, and then we showed an NCI at the bottom. Same with the P&L. You aggregate all of the subsidiaries' revenue, all of the subsidiaries' expenses, all of the subsidiaries' profits, and then you have to say, some of them don't belong to me. So at the bottom, you have to say, and you have to split how much of that profit is attributable to the parent and the NCI, and you have to do that both for the P&L profit and obviously what goes through OCI as well. So I put some numbers to it just to try and make it a little bit more accessible. So the group profit for the year is 100, but of that 100, some belongs to the NCI because some of that profit has been made in a subsidiary which we don't fully own. You've also then got to acknowledge, you've also then got to take into account that the gains of 15, they have been made, some of those have been made in subsidiaries, and so you're splitting it out 14 and 1, the numbers are arbitrary. So the total comprehensive income of 115, there's an analysis done there. And I just want you to be aware at this stage, this is how it could be looking in the exam. You wouldn't have to remember the format because it's a pre-populated spreadsheet. The information is presented, but we are fully aggregating the subsidiaries' assets, liabilities, income and expenses. In the balance sheet, you've got 3 of the elements: assets, liabilities, equity. And in the P&L, we've got the other 2 elements, the income and the expenses. Good. Now, bit of theory. I've already suggested this, but I'm just recapping. By having other comprehensive income, you're making sure that we're giving a complete picture. Because if you only report the profit of 100, it's misleading, it's incomplete. I want to be faithful, I want to be complete, I want to be useful. So I have to say my overall total comprehensive income is 115. Overall, my total comprehensive income is 115. But that includes a slightly dodgy, unrealized, one-off revaluation gain. So arguably, reporting the profit for the year is slightly more predictable, is slightly more relevant, arguably is slightly more useful because you can't pay a dividend out of a revaluation gain. Look, I'm straying into theory, but it is fundamentally a written exam. And the numbers, you need to understand the numbers and why the numbers are presented in that way. We move into looking at the group statement of changes in equity. Now you can see up here, there's a clown. This is supposed to be for fun. You will not be expected to produce a group statement of changes in equity in your exam. But I want you to understand what's going on and the relationship between the P&L and the statement of financial position. And this is all about equity. You've got here share capital, other components of equity, retained earnings, NCI. And we're showing the movement from the opening to the closing. Now, first things first, the most common thing is that you make a profit. And I'm using the same numbers that I was earlier. Our profit was 100. Our profit for the year was 100. But of that profit, some belong to the NCI. Yeah? So when you are increasing the group retained earnings, it's only going up by 80, and there is an element increasing the non-controlling interest. They're attributable to some of that profit. If you make a profit, the profit increases retained earnings and potentially the NCI. On the other hand, if you put something through OCI, if a gain is going directly to equity and is therefore also in other comprehensive income, that will boost other components of equity. P&L goes to retained earnings, OCI goes to other components of equity. And I'm using the same numbers. The overall gain was 15, of which the NCI had 1, and therefore other components of equity of the group goes up by 14. One last twist. It's the group retained earnings. So although we've made a profit of 80, we may not have kept it. There is a dividend paid in my world. There is a dividend paid in this example of 25. And the dividend paid to the equity shareholders is not an expense. Wasn't in the P&L. Dividends paid are not an expense. Dividends paid are an appropriation of profit. Dividends paid are a movement on reserves. Dividends paid are a reduction in the retained earnings. So minus 25 goes there. All right? Because the retained earnings is only going up by the retained earnings. The profit less the dividend that has been paid out. It would only go up by a figure of what? I don't know, net 55. I'm making up the numbers. You would not be asked to physically prepare this statement. Okay? I'm showing this to you for understanding. When you make a profit through the P&L, it increases retained earnings. When you've got gains and losses in other comprehensive income, they will then have an impact in other components of equity. That's the dynamic that's going on between the P&L, the statement of financial position. That's the difference between OCI, other comprehensive income, which is added on to the P&L, and other components of equity, which is a cumulative reserve on the balance sheet, a bit of a dustbin. Good. Fantastic. I hope you found that useful. It was a recap of the basics, but it shows you that I can get a little bit deep and heavy. You have the wonderful advantage, if you want to, of listening to this and watching this video again. My name is Tom Clendon. I help students pass SBR, and thank you very much for listening. Thank you very much for watching. Any problems, any issues, WhatsApp me.